We're going to take a look at 3 reasons why the concept called FIRE, F-I-R-E, or Financial Independent Retire Early may not work for you. I want to thank you for watching. This is Richard with Wisdom Investor. Our goal is to help you to accumulate a nest egg for retirement, help you build your financial wealth. I received a comment from one of our other videos, and we're going to take a look at this comment. Now, whether you have the same amount of money in this video, or if you have more or you have less, the principles apply to everyone. If you're thinking about retiring early, you're thinking about getting into the retirement age, or you're already retired, many of these concepts work for everyone. So I want to thank you for watching here. Let's take a look at this comment. I was planning on retiring at age 55, but got let go from my job this June at 53 and a half and decided to go with it. It's now October 14th and I'm bored out of my gourd. He goes on to say wife works. Then he says, now I've started to worry if I can live off the 1.2 million I've saved and if it's enough to last, even though I could easily live on less than 40,000 per year. And then he goes on down to say here, he's managed to save 30 to 40% of his income. So that's why he's able to retire early. And I want to just say congratulations to this person. This is a job well done. We all know that it's hard to even just save 10% in today's world. But saving 30 to 40%, excellent job for this person. And then he goes on to say, how do you feel about a certain fund? Vanguard Balanced Index Fund is 60% total stock market, 40% total bond. I'm looking for that simple balance all-in-one that tends to weather bear markets. The fund was down 22% in 2009. Total stock market was down 37% at that same time period. So he's concerned with the market going down. So we're going to look at these aspects of this comment here from one of our other videos. First here we're going to look at is I'm bored out of my gourd. He goes on down to say, I must not be eternally handling the change well after working for 37 years. Let's look at the stages of retirement. We have pre-retirement, planning. This person here was doing an excellent job of planning, saving 30 to 40%. The big day, well, that didn't exactly came. It looks like it was a surprise to him. Ended up retiring a year and a half early due to the job change. Honeymoon phase, never really had a honeymoon, so he was thrown right from working hard to right into retirement. So really didn't have a chance to mentally get prepared. Disenchantment, that's where he's at right now, trying to figure out where he's going to go in the future. So reorientation, building a new identity, and then routine, moving on. Right now, the reorientation phase is where this person's at. Maybe want to donate some time, find some hobbies, or find something of interest that he wants to do. Or he might even want some type of a part-time job. Let's look at the next part of this question, this comments. Now I've started to worry if I can live off the 1.2 million I've saved and if it's enough to last, even though I could easily live on less than 40,000 per year. Now keep in mind, the amount of money you've saved is most likely going to be different. You may have 3 to 5 million, you may have 100 to 200,000, but the principles here all apply to all of us. The Bureau of Labor Statistics said the average retired person spends about $49,000 per year. Well, a couple of years have gone by, that's probably going to be a higher number. But here's some of the average costs. If a person can get their house paid off, that's going to be a big lift on expenses. Now, this person wants to spend about $40,000, so they're going to have to look at all of their expenses and make sure that they can keep their cost at $40,000. And we all know it's not that easy to cut cost. Now here's what article from MarketWatch says, this is exactly how much it will cost to retire well in every state in America. And Bankrate.com did some surveys here. I'm not going to list every state here. This particular person is in Illinois, and they show that the average cost of a person retiring to live comfortable is $59,000 per year. So it is expensive out there. I totally understand that, and I know everyone else does too. But you can see in most of these states, it could be anywhere from $54,000 to $100,000 if you're in Hawaii. So we've got to get our cost under control. Let's get a realistic picture of how far 1,200,000 goes. So if the standard withdrawal rate is about 4%, so we'll multiply this by 4%, 0.04, and that gives us $48,000 per year. Now that's only going to last for 25 years if it's not invested. We're estimating that this person could go for or live for another 32 years. Now, taking out $48,000 per year may be more than his savings can hold. The other option is to use a lower amount. Let's take, or 1.2 million. Now we're going to take a look at a lower percentage, taking out 0.03 or 3% versus the 4%. So multiply this 1.2 million times 0.03, and that gives us $36,000 per year. He's thinking about spending a little less than $40,000. We looked at the other numbers. 50 to 55, 60,000 is the average. Now the 36,000 withdrawn per year is going to last 33 years. So his goal here is to maximize his 1.2 million. He needs to get some growth off this 1.2 million so that he can increase this amount that he's going to withdraw. He needs to be able to withdraw somewhere between 36,000 and the 48,000. So we're going to take a look at how we can get some growth. Let's look at the rest of his question. How do you feel about Vanguard Balanced Index Fund? It's 60% total stock market, 40% total bond. I'm looking for the simple balance approach. Fund was down 22% in 2009, while the stock market was down 37%, which is significant. This person is looking at the possibility of the stock market going down. He wants to be in a balanced fund. He doesn't want to take a lot of risk, but he needs growth over time. So he said he's 53 and a half. We're going to say he lives 32 years. That gets him out to about 85. If he just put his money in savings, in cash, and he withdrew 40,000 per year, that's 3.3% of his savings. He's getting no growth when he's just in cash. And if we run a simulation on this is 32 years here, and we can see that he's got a good chance of his money running out before 32 years goes by. Okay, we're going to look at the nest egg calculator here. If we invested 60% in stocks, 40% in bonds, taking out about $40,000 per year over 32 years, and we run a simulation on that, you can see that he's right on target on that his money is going to last him much longer. He's going to get his 32 years. So our viewer's strategy, 60% total stock market, 40% bond, is going to work for him. The other concern was if the market takes a dip, what that's going to do to his funds. Let's take a look at that. Okay, we're looking at the S&P 500. This is a monthly chart all the way back to 2000. So here's what our viewer is concerned about. If this market starts to move lower and he's having to withdraw funds, that can eat into his funds real quick. If you have a 37% down year and then you're also taking money out of that, it's going to take a long time to build that money up, and your money can run out much quicker. So let's look at this in a little bit more detail. We're looking at what's called a sequence investment withdrawal risk. Here's a situation here where initial investment's $100,000. You're going to withdraw $5,000 per year. So you start with a $100,000. Now the return here is a -9, a -11, -22. So if you started retirement and the first 3 or 4 years were negative, let's see what impact that has on your savings. So after 3 years, after a -9, a almost 12, and a -22, and withdrawing $5,000 per year, your money, your $100,000 is going to be down 50% in just 3 years. Let's reverse the situation. $100,000 investment, withdrawing $5,000 per year, but your returns are to the positive side, 13.69, 32.39, and 16. You can see here the money's going to continue to still grow even though you're taking $5,000 out per year. Okay, so just to recap our subject here today, our viewer here said he was bored. We talked about some ways to start having more activities in life. We also looked at making his savings last the entire time he's in retirement, and also looked at some of the expenses in retirement, such as what it costs to live in various areas. He's doing a great job of saving his 30 to 40%. And we also looked at this sequence investment risk if investments went down before in the first few years of his retirement versus going up in the first 3 years. So I want to thank you for watching our 3 reasons why FIRE, financially independent, retire early, may not work for you. Thank you for watching. If you haven't subscribed, please subscribe to our videos.